What's next, Steve?
Next is a company called AEW UK REIT, ticker symbol LSE AEWU. I say that because there are a few companies with similar-ish sort of names in various different markets and exchanges and so on. They're a smallish UK REIT, and they have about 34 properties that are scattered around the country, but none of them especially near where you live or I live, Steve. There's a nice sort of blast area which has been entirely evacuated by people from there. 13 industrial distribution centres, 12 retail properties, some gyms, some cinemas, some leisure centres, a couple of offices, that kind of thing. And stock comes with a 7.5% dividend yield. End of discussion. On to the next thing. But no, this is actually an interesting UK REIT, and I'm going to hat tip to the Investor Way who were talking about this and thought it also looked interesting, but I thought I'd bring it to the attention of some of our listeners here. So AEW has, in a lot of cases, the opposite of what you look for in a REIT, or what we conventionally look for in a REIT. So what we typically look for is big, long lease expiries, so you're not going to have to deal with vacancies at any particular point in the near future, and fairly well-hedged debt for the kind of long term. It's got neither of those things. Their average lease expiry is about 4 years or so away. Normally, you would think of that as a red flag. And they have about 60 million in debt. This is quite a bit of debt by their standards. That's 3%, and it's set to mature in 2027. Neither of those things is very good, or at least at first sight anyway. But they have a slightly unusual strategy that's worth looking at a little bit closer. So where we mostly look for long demand, what we're looking for usually in REITs is areas that have quite high demand. So normally that means industrial distribution stuff, but we tend to stay away from all the things where we think demand is going to be weaker, like offices and so on. But that's only half the supply and demand equation, of course, right? So the concern with warehouses recently in the UK is that, well, people have seen massive demand for them, rise of e-commerce, so on and so forth, going back sort of 5-10 years now, and been building loads of these things as well. And what matters in all of these cases, and I think AEW are onto something good here at the very least, is that it's the balance between supply and demand that matters, right? If you have massive demand and massive supply, that's kind of equivalent to having fairly low demand and fairly low supply, because price is a function of those two things. And if you move one half of the equation, that's good. But if you move both halves of it together, well, then nothing really happens. And what they focus on instead is areas where supply is limited, basically, rather than where demand is kind of growing and strong. They look for places that are undersupplied, and that means the tenants who are in these properties, if they want to keep operating, they don't really have anywhere else they can go. And with a lack of supply and a lack of supply coming online, that can lead to pricing power of a sort, and that's connected to their relatively short lease expiries. They see lease expiries as an opportunity. If you think about REITs and the way they typically work, if you're tied into a long-term deal as a landlord, you can't renegotiate in the middle of it. So if we think of primary health properties and supermarket income REIT and some of the other ones that I've gone on about in recent months on this show, wherever they've been seeing growth in their kind of 6-month, 3-month, whatever reports, it's generally been as a result of renewals and renegotiations and renewing at higher rates and so on. And once they're kind of fixed, there's not an awful lot they can do about it. Supermarket income REIT is generally tied to inflation, but that's mechanical. That's not a way that's going to drive meaningful growth, and it's almost certainly going to be offset by inflation because that's what it's tied to. So the story there is that you need to get a big enough dividend yield because it's not going to go up an awful lot for a long time because they're on long lease expiries. On the other side, the thing you really don't want is big long lease expiries with near-term debt expiries. And you don't want to be refinancing your debt 4 or 5 times while your rental income is fixed, especially not if you're going to have to refinance it at higher rates along the way. And so this is the thing that AEW are quite focused on here, right? So what they look for is properties where they can add value somehow, either by refurbishing them, repurposing them, getting permission for different use cases, generating higher rent out of them by a contract that's expiring and renewing it, or just selling the thing, basically. And their track record in this, Steve, has actually been kind of sneaky good. They have done pretty good job of buying things, getting permission to use them for different types of purposes, refurbing them if need be, renewing leases on better terms, moving them on, and this has worked quite well. So if you compare them to, they do have a short debt maturity coming up, but on the other side of that, it's reasonably short until a lot of their leases expire, and they're going to get a chance to offset this with some higher rental stuff if they're right about their supply side shortages. So if you compare that with something like a supermarket income REIT, they have longer lease expiry. They're about 10 years or so, but their loans are up in 4 years, which means that if they renew them for another 5, they've got 2 lots of who knows what in terms of debt financing. Ideally for them, if rents come down, if interest rates come down, they might manage to refinance cheaper, but that's not guaranteed. And they are currently renewing around 5 and a bit percent. And their general cap rate is sort of 6-7 or so, and that's not much of a spread for what you're buying and what you're paying on debt. So this all gets kind of tight a little bit there. So yeah, growth is always a challenge when you're a REIT. If you have to give away all your cash to shareholders, it becomes hard to grow. You have to try and grow through debt, and that's almost always a challenge. But the most obvious chance you get to try and exact some sort of pricing power on something is a lease renewal. And AEW, I think, have a kind of interest. At the very least, they have an interesting strategy here. It's been working well so far. They're relatively small, so my suspicion is that they're not necessarily going to run out of opportunities for scale. Lots of REITs go through a process of what they call recycling capital, which is to say buy something, improve it, and then try and shift it on again, and then go and buy the next thing because that's sort of what they have to do. But it's an interesting idea, I guess, of trying to generate growth or help generate growth by looking for things where actually remaining terms to expiry are pretty short, and we're going to get a chance to try and extract a higher rent in the nearish future, where everyone else kind of sees uncertainty because, hey, your tenant may run away. They tend to see, well, we can renegotiate that at least then, and there's not a huge amount of supply elsewhere. What do you think, Steve?
So I didn't know a lot about this company up until about an hour ago when I remembered you were doing it. I had a brief look, and I was hoping to see somewhere that I knew, so I could kind of put a sort of a pin on the map as where I've seen this place before, and I haven't. So, and that's not to be surprised. They've only got about 20 or 30 locations in the UK, so it's not like it's not as widespread. Steve knew one of the areas, and it was closer to me than him. But and I've been to Sheffield about 300 times, and I couldn't picture where it was on a map. But what I do like about this company is they've got this kind of sort of 4 criteria for purchasing properties, and they're essentially looking for companies that have properties that have low capital value. So they're looking for the property, the cost under £20 million, and they want it to have low passing rents, which is a strange thing for them to look for. But the idea behind that is that, and it forms with some of the later part of the strategy, but it provides future growth potential for them. They like it to have an initial net yield at the time of purchase of around sort of 7 to 10%. But the kicker here is that they want the leases, the people in those buildings, to be on short leases, because that gives them an opportunity to renegotiate or to lose the tenant and redevelop the property for something else. So they essentially add value to these products or add value to these properties through doing refurbs, improving the tenant leases, or getting planning permission to change the use of the building to something that they think they could get a higher rent for. They've actually done rather well. Like you said, Steve, they're sneaky good at this. They've got a strong track record. Their benchmark is the MSCI quarterly property index, and they've they have actually doubled the benchmark index in the last year. 14.8% they got on their total property return. The benchmark was 7.4%, and the shareholder total return over the period was nearly 28% as well. So it's pretty good, really. The management team pointed to this strategy earlier. They call it their value-driven strategy as a reason for the outperformance. And key to note, that's been in a period when the property market has been weak, Steve. So it's even better than you think. So 34 assets, about 216 million quid of assets. That's around what they trade at. They're trading at about 1 times book, which is a decent metric for measuring the health of a REIT, how rich it's trading. I think it looks pretty interesting to me, Steve. Really, I think it's got an interesting portfolio. It has closed that gap up now between its book value, which is one of the things they remarked in their earnings call that they were happy to see happen. But yeah, it looks to be in pretty good nick, really. I mean, the fixed cost of its debt at the moment is 2.959%, Steve. That's cheap debt. Just acquired an £11 million building, a leisure asset in Leicester, which they think has a yield of 10.6%. That's pretty high. They've got a sale going through at the moment for the retail park in Coventry as well. So, they're quite happy to buy and flip here. It'd be interesting to see exactly what happens. The issue with them being so small is a bit like supermarket interest REIT, Steve. When they sell a supermarket, it can knock like 10% off their earnings, because that's how much is genuinely is gonna go missing. And they're a little bit like this. They've got a couple of portfolios, a couple of properties that make up over 6% of the portfolio. So there's one in Bath, one in Gresford. There's a 5%er in Dagenham, but this looks like a pretty big leisure park, and the same in Leicester of 5%, and in Bath as well. There's one over 5%. So there must be some pretty big yielding properties there. So there's definitely some concentration risk to a degree. But this is a smartly run operation. So you would think if they were shipping off a 6% property, they'd have an idea of where that money's got to go and why they need to do that. So yeah, I'm quite impressed with this. I think this is pretty interesting, Steve. Are you going to buy it?
It's a good question. You mentioned their debts at fairly low levels. They are refinancing in the near future. That will probably go up. But in terms of kind of gearing levels, they're not super high for a REIT. They are thoughtful and sensible with their balance sheet, and that's also kind of interesting to me as well. Am I going to buy it? It's a good question. Not sure. I'm not sure I have a great reason for not buying it. I'm kind of held back partly by the thought of, like you, there's concentration risk in this, and the size of these things means things can go wrong fairly dramatically, and it's up trading near the point where the dividend becomes, well, dividends are always a little bit of a tricky thing. They have a choice if they're a REIT, so no complaints about this particularly, but the closer you get to sort of book value, the better off shareholders are if you just hold on to the cash, because it means that your excess cash is every 1p per share you hold on to is pushing the share price up by more than 1p. But while they're below it, it's not pushing it up by as much, so you might as well dividend it out and give people the 1p. We will see, I guess, on this one. I'm certainly not ruling it out. I'd like to sort of look a bit closer. It does look like a smart operation here. I don't necessarily think they're under much pressure from the kind of supply side here, because it's the kind of thing where if anyone else does come in and try to compete, probably the case that kind of undersupply disappears for everybody. So we will see. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.